Since summer 2014, the price of a barrel of crude oil has crashed from $115 down to $28 in January and $40 to $45 now. This has caused carnage for companies that make a living out of pulling oil and gas out of the ground. And nowhere has that been felt more strongly than in the UK North Sea, the most expensive place in the world to drill for oil. I'm talking to Tony Durrant, Chief Executive of Premier Oil, one of the biggest independent oil and gas companies working in the region, about what this has meant for his company and how long is left in one of the world's oldest oil and gas basins.
It feels as if amongst all commentators we're off the bottom. We've seen the oil price recover to somewhere in the mid-40s. Share prices, of course, have recovered as well. But I think a lot has been done to attack the industry's cost base, which frankly was necessary, and a lot of progress has been made.
Oil in the $40 range is still not enough for a lot of you and a lot of your rivals to make profits, though, in the North Sea, is it?
Well, I think our operating costs are $15 a barrel. We've probably got cash interest costs of somewhere in the $5 or $6 a barrel. So our individual fields are profitable. But of course, we're in a business where you do need constant investment and reinvestment. Some of that is just to maintain our existing fields. Some of that is to replace the production. So it's not that our individual fields are unprofitable, but we do have to constantly look at maintaining and hopefully growing our business as well.
During the good times, oil companies spent more and more getting oil out of trickier and trickier places. Now oil is less than half the price it used to be. They're having to re-evaluate their entire business model, and whether that means laying off staff, buying cheaper equipment, or simply stopping large chunks of what they do, companies are desperately having to cut costs.
Of course, as activity levels have dropped with lower oil prices, then there's been pressure on the service companies to cut back on their margins. And indeed, most of us have made cutbacks around about 30% in operating costs last year. But I think we're now into a second phase, really, which is greater collaboration between the upstream companies. And there's a lot of efficiencies that we can achieve just by collaborating with other operators, shared infrastructure, terminals, warehouses, rescheduling of helicopters to become more efficient, procurement joint ventures so that we have greater buying power, even sharing some of our back office functions.
Yeah, you've talked about joint procurement in the past. How does that work in what is an incredibly competitive industry?
Well, it is, but frankly, 3 or 4 of us clubbing together can still have greater buying power than each of us on our own. We're not really talking about Premier joint venturing on procurement with BP and Shell. They have far bigger operations than us. But for companies the same size as us, or at least with the same size North Sea operations, I think there's an opportunity to get together and exercise greater buying power and more efficiency in procurement.
And tell us just a little bit about the thinking behind your deal to buy E.ON's North Sea assets. What are you doing buying more assets in such an expensive basin?
Well, I think, first of all, you can't generalise completely about the basin. I mean, there are some older fields which are higher cost because they're producing at much less than they once were. But our assets, and indeed most of E.ON's assets, are not really those older fields. We're buying assets from E.ON and indeed bringing our own assets on stream where the costs are in the $8 to $10 a barrel. So it's important not to write off the North Sea in one fell swoop. There are many different portfolios. As regards the E.ON acquisition, in the past Premier has chosen to step into the acquisition market when the markets were weak. We did the same in 2009, and frankly we've done the same this time. We think we've got a very good transaction with E.ON. It's been very well received by the market, and I must say we've also had the support of our banks and bondholders, which is not straightforward at the bottom of the cycle.
When the oil price was high, companies were spending more and more, but getting less and less out of the ground. Production figures for oil and gas from the UK North Sea have slumped over the last 5 or 6 years. And even though figures have now stabilised in the last year or so, Even under the most optimistic scenario painted by Oil and Gas UK, the industry body, production is never going to return to what it was just 5 years ago.
The North Sea has a long time left. We've produced only 60% of the reserves and resources in the North Sea.
Tony Durrant, thank you very much.
Thank you.